Operating leverage is a cost accounting formula that measures the degree to which a firm or project can increase operating income by increasing revenue. A business that generates sales with a high gross margin and low variable costs has high operating leverage. The higher the degree of operating leverage, the greater the potential danger from forecasting risk, in which a relatively small error in forecasting sales can be magnified into large errors in cash flow projections. The operating leverage formula is used to calculate the company's break-even point and help set appropriate selling prices to cover all costs and generate a profit. The formula can reveal how well a company is using its fixed cost items, such as its warehouse and machinery and equipment, to generate profits. The more profit a company can squeeze out of the same amount of fixed assets, the higher its operating leverage. One conclusion companies can learn from examining operating leverage is that firms that minimize fixed costs can increase their profits without making any changes to the selling price, contribution margin, or the number of units they sell. Operating leverage can also be measured in terms of change in operating income for a given change in sales revenue. The degree of operating leverage, DOL, can be computed in a number of equivalent ways. One way it is defined as the ratio of the percentage change in operating income for a given percentage change in sales. The degree of operating leverage is a method used to quantify a company's operating risk. This risk arises due to the structure of fixed and variable costs. Fixed costs do not allow the company to adjust its operating costs. Therefore, operating risk rises with an increase in the fixed to variable costs proportion. Generally, a low DOL indicates that the company's variable costs are larger than its fixed costs. That implies that a significant increase in the company's sales will not lead to a substantial increase in its operating income. At the same time, the company does not need to cover large fixed costs. A high DOL reveals that the company's fixed costs exceed its variable costs. It indicates that the company can boost its operating income by increasing its sales. In addition, the company must be able to maintain relatively high sales to cover all fixed costs. It is important to compare operating leverage between companies in the same industry, as some industries have higher fixed costs than others. The concept of higher-low ratio is then more clearly defined. Most of a company's costs are fixed costs that recur each month, such as rent, regardless of sales volume. As long as a business earns a substantial profit on each sale and sustains adequate sales volume, fixed costs are covered and profits are earned. Other company costs are variable costs that are only incurred when sales occur. This includes labor to assemble products and the cost of raw materials used to make products. Some companies earn less profit on each sale, but can have a lower sales volume and still generate enough to cover fixed costs. For example, a software business has greater fixed costs in developers' salaries and lower variable costs in software sales. As such, the business has high operating leverage. In contrast, a computer consulting firm charges its clients hourly and doesn't need expensive office space because its consultants work in clients' offices. This results in variable consultant wages and low fixed operating costs. The business thus has low operating leverage.